Welcome to Iron Financial, where we give you the cold, hard data you need to forge a stronger portfolio and ruthlessly cut through market weakness. I'm your lead analyst, and today we're executing a strictly numbers-driven teardown of the most aggressive public offering in the history of capital markets. I'm talking about the SpaceX IPO. Hit subscribe right out of the gate because we don't do hype here. We deal in the raw S-1 data, structural mechanics, and the actual balance sheet.
And I'm your market skeptic. Look, we really need to cut through the noise immediately on this explainer. Every single retail trader out there is staring at the ticker symbol SPX right now, completely caught up in the rocket launches, the Mars colonization narratives, and the massive AI hype. My job today is to ask the single most important question. Are investors buying a rock-solid industrial powerhouse, or is this just a hyper-inflated meme asset built on a foundation of structural cash furnaces? Let's rip this open.
We have to start with a valuation hook. The implied IPO price was fixed directly at $135 per share. There was no initial range. They skipped the standard institutional book-building dance entirely. They simply handed the market a number and struck the gavel. On listing day, June 12, 2026, it opened at $150 and closed up over 19% at exactly $160.95. Intraday, it peaked at a highly volatile $176.52. At that closing price, SPCX commands an astronomical market capitalization of over $2.1 trillion.
$2.1 trillion. I mean, let that sink in for a second. That is an absolute skyscraper of a valuation. At that height, there is literally zero room for structural failure. You are pricing in absolutely flawless execution for the next decade. As a retail investor, when I see a $2 trillion price tag on day one, my immediate instinct is to grab a flashlight and look for the cracks in the facade. Because if that foundation shifts even a single inch, the whole structure collapses.
Let's run the multiples reality check, because the numbers here are staggering. At its listing valuation, SPX is trading at roughly 94 times its full year 2025 revenue, and that revenue sits at $18.67 billion. Market skeptic.
And right there is the structural absurdity of that multiple. SpaceX currently commands a higher revenue multiple than Meta and Tesla combined, yet it generates less than a tenth of the top-line revenue of an Alphabet or an Apple. I mean, Apple prints over $380 billion in revenue. SpaceX is at $18.6 billion. You are paying a 94x premium for what is fundamentally a heavy machinery and aerospace logistics business. From where I'm sitting, that is a highly dangerous, over-engineered premium.
Section 1. The drill down. Space Launch Foundation. We have to inspect the load-bearing pillars of this business, starting with the industrial heavy lifting of the Falcon fleet. Now, they deliver over 80% of global mass to orbit. That's a fact. But a dominant fleet doesn't automatically equal a profitable balance sheet. Out of that $18.67 billion total 2025 revenue, connectivity, which is Starlink, drove $11.39 billion. Space Launch, the business everyone actually associates with the company, brought in just $4.09 billion, and the newly acquired AI segment generated $3.20 billion. Space Launch is visibly dwarfed by the connectivity segment. Wait, hold on. So the rockets themselves, the highly visible, heavy machinery actually delivering 80% of global mass to orbit, are only bringing in $4 billion in top-line revenue? That is a massive red flag for the core narrative. If they completely dominate the entire global launch market and still only print $4 billion, where is the upside growth for this specific pillar? The reality of the launch market is brutally revealed once we look at the bottom line. That $4.09 billion in revenue resulted in a GAAP operating loss of negative $657 million for the space segment in 2025.
So the armor is heavily cracked right out of the gate. They are launching rockets at a record cadence, landing boosters like commercial airplanes, and they are still structurally unprofitable under GAAP. How does that actually happen?
It's an internal mechanics issue. The space segment is heavily utilized to launch their own Starlink satellites. Because those are internal payload deployments, they generate zero inter-segment revenue. Space Launch eats all the fixed costs, the heavy operational overhead, and the booster depreciation, but they simply don't get paid by a third-party customer for those flights. And then you have the heavy machinery investment. In 2025 alone, the space segment absorbed a massive $3.0 billion R&D cash burn explicitly for the Starship program. Starship is the next-generation launch vehicle. It's not a pet project. It is the absolute required heavy infrastructure needed to deploy their future orbital AI compute and the larger Starlink arrays.
$3 billion in pure R&D burn. So they're essentially treating the launch segment as a massive loss leader just to build out the orbital infrastructure. That means the launch division isn't a profit center at all. It's a huge, capital-intensive utility company that requires constant, heavy cash injections just to survive and maintain its market share.
Section 2. Starlink. the load-bearing cash cow. If space launch is the cash furnace, then Starlink is absolutely the load-bearing cash cow carrying the entire $2.1 trillion enterprise. The financials here are robust. In 2025, Starlink generated $11.39 billion in revenue, and more importantly, it printed a GAAP operating income of $4.42 billion. This is the green on the ledger. This segment is highly verticalized, their user terminal production costs have plummeted, and they are monetizing the orbital network aggressively. This is the solid steel beam supporting the rest of the business.
Market skeptic. Okay, I will admit, a $4.4 billion operating income is serious operational profitability. But we really need to look at the unit economics here. You don't just buy top-line revenue, you buy the margins. And when I look under the hood of Starlink's retail expansion, I'm seeing severe margin compression.
The raw metrics reveal the reality of this expansion perfectly. From early 2025 to early 2026, Starlink subscribers violently surged from 5 million to over 10 million. They doubled their base in roughly a year. However, global average revenue per user, or ARPU, dropped from $99 per month down to $81 per month. And there is the structural margin squeeze. An 18% drop in ARPU is brutal. They are flooding the system with massive retail subscriber volume, but to actually get that volume, they're expanding into lower-tier international markets and pushing cheaper service plans. They are trading premium pricing for raw scale. If ARPU keeps sliding down that curve, that $4.42 billion operating income is going to structurally weaken right when they need it the most. Section 3. XAI, the financial sinkhole. They absolutely need that Starlink cash because of the third pillar, the AI segment, formally acquired and consolidated into SpaceX in February 2026. Prepare yourselves because we are exposing a massive structural sinkhole right now. When you read the S-1 headlines, the underwriters want you to focus strictly on the adjusted EBITDA. For full year 2025, SpaceX posted a seemingly strong adjusted EBITDA of $6.58 billion. But when you strip away the accounting adjustments and look at the actual GAAP net loss, the company bled out negative $4.94 billion for the year.
This is exactly why retail traders get slaughtered on the floor. They read a flashy press release touting $6.5 billion in EBITDA, and they blindly buy the float. But EBITDA ignores depreciation, it ignores stock-based compensation, and it completely ignores the massive capital expenditures required to keep the heavy machinery running. A near $5 billion GAAP net loss means the structure is leaking cash at a catastrophic rate.
And the bleeding is actively accelerating. In Q1 2026 alone, the GAAP net loss violently spiked to negative $4.28 billion for a single quarter. Let me repeat that because it's absolutely crucial. $4.28 billion lost in just 3 months. This relentless cash burn has driven SpaceX's total accumulated deficit to a staggering $41.3 billion.
$41.3 billion in accumulated deficit. That is not just a pothole on the balance sheet. That is a canyon. You are buying into a $2.1 trillion valuation on a company that is structurally burnt through tens of billions of dollars. And we have to ask, where exactly is this massive Q1 crater coming from?
It comes directly from the AI segment. In 2025, the AI segment blew a massive hole through the balance sheet, posting a loss from operations of negative $6.36 billion. And in Q1 2026, it posted an additional operating loss of negative $2.47 billion. So this isn't a load-bearing wall at all. This is a complete structural liability. The AI segment is consuming literally every single dollar of profit that Starlink manages to generate, and then some. They are basically taking Starlink's hard-earned cash, putting it in a wheelbarrow, and shoveling it directly into the AI furnace. Let's break down the heavy machinery costs of this AI expansion, because these are massive anchors bolted directly to the balance sheet. In Q1 2026, capital expenditures for the AI segment were an immense $7.72 billion. Why? Because SpaceX relies heavily on external infrastructure to bridge the gap while they build their own. They have a $1.25 billion per month cloud services contract with Anthropic running all the way through 2029 at the Memphis Colossus data center cluster. Add to that their sweeping code collaboration deal with Cursor, which features a massive $10 billion breakup and deferred services framework. Market Skeptic? A $1.25 billion per month contract? That's insane. That is over $15 billion a year in fixed cloud costs just to train and run their models. That is a concrete weight dragging down the entire enterprise. If those AI models don't immediately monetize, and I mean heavily, this CapEx anchor will completely drown the company's liquidity. Section 4. The hidden market arbitrage. From a purely fundamental perspective, you are right to be skeptical, but the market is not a purely fundamental machine. We are shifting our focus right now from internal balance sheet bleeding to external market forces. On May 1, 2026, the Nasdaq enacted a game-changing index inclusion rule. Under the old rules, newly listed companies had to wait 3 months to be included in the Nasdaq 100. The new rule allows top 40 market cap companies to bypass that wait entirely and be fast-tracked into the index within 15 trading days. SPCX listed on June 12th. This rule was practically tailor-made for SpaceX. By fast-tracking SPX into the Nasdaq 100, the exchange structurally forces an absolute avalanche of passive institutional capital, ETFs, mutual funds, pension funds, to aggressively buy the retail float regardless of the valuation or those gap losses we just broke down.
This is the hidden arbitrage, folks. It has absolutely nothing to do with rockets or RPU or AI models. It is pure mechanical plumbing. Passive funds are entirely price insensitive. If SPX is in the index, they must buy it to match the weighting. This creates a highly engineered demand shock that structurally inflates the stock price and masks the bleeding fundamentals we just exposed.
Lead Analyst, Section 5. Welding your final portfolio. Lead Analyst, it is time to weld together the actionable takeaways for all the investors watching this teardown. You have the raw S-1 data, and you have the market mechanics. Let's summarize the structural integrity of this trade. The IPO was fixed directly at $135 per share. Crucially, 30% of the float was allocated directly to retail investors. That is 3 times the standard allocation for a mega-cap IPO. On the institutional side, a reported $5 billion BlackRock order anchored the initial demand, giving the market immense confidence.
Market skeptic? But do not let that institutional prestige blind you to the raw risks. You are buying into a company with a $41.3 billion accumulated deficit. You are buying a 94x revenue multiple. You are buying a business where the AI capex is violently accelerating and Starlink ARPU is actively compressing. The foundation here is highly volatile.
I align perfectly with Nicholas Owens from Morningstar on this one. His directive is clear, quote, "Wait for the stock to settle before buying. You absolutely must maintain a cautious, defensive posture against this hype machine. Let the passive fund demand shock wash through the system. Let the 15-day Nasdaq inclusion volatility burn out entirely. Do not buy the top of a 94x multiple just because everyone else is looking at the stars." The data is on the table. The structural realities of the space launch furnace, the Starlink cash cow, the AI capex sinkhole, and the Nasdaq inclusion arbitrage have all been ruthlessly torn down. Now the final hammer falls to you. Will this $2.1 trillion foundation hold its ground? Or will the massive weight of a $41 billion deficit cause it to structurally fail? Use this cold, hard data to understand the foundation of your own portfolios. Cut through the market noise. Analyze the structures with absolute discipline, and hit subscribe for more relentless financial teardowns from Iron Financial. We'll see you on the floor.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.